Let's face it, crypto is volatile, like really volatile. By the time you've finished watching this video, Bitcoin may have moved a few pips. Of course, there is one type of cryptocurrency that's designed to be the exact opposite of this, a decentralized stablecoin that can hold a dollar peg all without the intervention of any entity. My name is Guy, and in this video, I'll be giving you everything that you need to know about DAI, the stablecoin developed by Maker DAO. Among other things, I will also take a look at what a decentralized stablecoin is, how it maintains the peg, competing stablecoins, and what I think the future holds for DAI. So be sure to stick around till the very end for my personal take. Before we get going, I need to make a few things clear. Nope, I'm not a financial advisor. Sorry to disappoint you. So please do speak to yours before you consider crypto, stablecoins or otherwise. Also, if you're new to the Bureau, it's a pleasure having you here. I release regular reviews, so I suggest you subscribe as well as turn on those notifications. That way you won't miss them. Alrighty, let's dive into DAI. Now, before I can take a look into the mechanics of DAI, I need to run through a few basics on stablecoins. Stablecoins are just as the name implies. They are a cryptocurrency that has stability as their primary feature. They are pegged to the value of another asset and will hold the same value with that asset through time. Stablecoins can be pegged to any assets: commodities, a price index, a real asset, and even other crypto. However, they are mostly pegged to fiat currencies like the US dollar or the British pound, etc. So when you say that a stablecoin is pegged to the US dollar, it means that one unit of that crypto will always be equal to $1 US. One DAI should always be worth $1 US. Why is that, you ask? The dynamics of stablecoins ensure that any deviation opens up arbitrage opportunities. How this works depends on whether they are fiat-backed or use a collateralized crypto debt like DAI. I'll cover this all in a bit, so stay tuned. Another important point to illustrate here is that this also means that the stablecoin will also collapse if ever the US dollar was to collapse as well. You're holding a stablecoin merely to hodl value in pegged currency or asset. It's not a price play. If the US dollar depreciates in value from trade wars, actual wars, or just through inflation, so too will the pegged value of your stablecoin. So that's an important point to understand. Now, as mentioned, there are two different types of stablecoin. You have your centralized version and then you have the decentralized type. The centralized variant are stablecoins that are usually backed by fiat currency that is held by some central entity. This could be an exchange, a trust, or some other form of organization. Perhaps the most famous centralized stablecoin that you've heard of is Tether or USDT. Tether claims that for every one Tether they have put out on the market, there is $1 in their bank account. This has of course been disputed over the years, but that's a topic for another video. Tether is not the only centralized stablecoin out there though. The space has kind of mushroomed over the past 2 years. You have the likes of USDC, Pax, TrueUSD, etc, etc. Oh, and while we're on this, I've done a separate video that covers the top 5 stablecoins that are currently on the market. So you can check it out right here if you want a bit more of a competitive analysis. Now, one thing that all of these stablecoins share is that it is up to the issuing authority to maintain the peg. They need to make sure that the supply of US dollars exactly equals the supply of stablecoin. Every single dollar redemption has to see a unit of the stablecoin taken out of supply or burned. This ensures equilibrium and upholds confidence in the market. This confidence in turn leads to a situation where any mispricings away from the peg are quickly arbitraged out. Of course, we're not here to talk about centralized stablecoins. The DAI is able to maintain the peg without any fiat currency backing it. It is backed by collateralized crypto debt that is maintained on a decentralized ledger through the use of smart contracts. Okay, I know that's a bit of a word salad, but bear with me as I explain it in a bit more depth. DAI was launched in 2017 and was developed by the folks over at Maker. For those who don't know, Maker is a decentralized autonomous organization or DAO that was built on the Ethereum blockchain. Maker is trying to develop a line of decentralized stablecoins that will be tied to other assets. They've issued two tokens, namely the Maker MKR and the DAI stablecoin, both of which are ERC20 standard. If you want a more in-depth overview of Maker, then I've done a separate video on the topic. But, to give you a short snippet, Maker holders are essentially in charge of the risk management of the DAI ecosystem. They can take important decisions that relate to DAI issuance, risk parameters, target rates, global settlement decisions, and much more. Prior to the launch of the multi-collateral DAI, the MKR tokens were used in order to pay the stability fee for those who take out loans in DAI. You can think of this stability fee as akin to interest on a normal loan. Given that the DAI stablecoin is an ERC20 token, this means that you can easily store and transfer it like any other Ethereum-based token. Imagine that, a coin that will always be worth $1 that you completely control. Nobody to back it and no one need to audit any reserves. Okay, you're probably wondering how the hell it maintains its peg. So let's take a look at that, shall we? DAI is able to maintain the peg through a careful balance of economic incentives and game theory. Essentially, the system creates arbitrage opportunities every time there is a deviation from the one-to-one peg. And by arbitrage opportunity, I mean a risk-free way to make a few bucks from said mispricing. The mechanics behind this are really quite ingenious. Basically, users can borrow DAI by placing their cryptocurrency into what the Maker team calls a vault. In the days of single collateral DAI, this was termed a collateralized debt position or CDP. Currently, the collateral can be Ethereum or Brave's BAT token. For the purposes of this example, we will assume that they are locking Ethereum. So, a user locks their ETH into the vault in order to unlock the DAI. They can just as easily send the DAI back, along with a fee, in order to unlock the collateral that they posted. This is all managed in the vault through the use of a decentralized smart contract. Now remember, as a holder of ETH, you can use your crypto and generate DAI for only $1. If DAI is being sold on an exchange for more than $1, then you can quickly unlock the DAI and sell it for a quick profit. So let's assume that DAI is trading for $1.09 on Coinbase, and then you can create DAI right now by sending ETH to the vault. Once the DAI is unlocked, you ping it over, hit that sell button and pocket your 9-cent profit. This incentive mechanism means that the supply of DAI is automatically adjusted to reflect pricing differences. Given that you're unlocking DAI in order to sell it on the market, you are increasing supply. And what do we know from Economics 101? Increase of market supply with a flat demand leads to a fall in price. And this mechanism also works the other way. If the price of DAI falls on the open market below the $1 peg, someone who has borrowed DAI can buy it and then use it to unlock their Ethereum in the vault. Remember, the borrowed DAI was worth $1 and they are paying it back after purchasing it at a lower price. So, back to a practical example. If DAI is trading for 95 cents on Coinbase, you can buy it there and send it to the vault. DAI that you initially unlocked and sold on the open market for $1 has effectively only cost you 95 cents when closed. This is effectively a 5-cent profit less the stability fee. Also, given that you're taking DAI off the market and locking it up, you're reducing supply. Let's pull up that demand-supply graph again. A decrease in supply holding demand constant means, yep, an increase in price back to the equilibrium level. Pretty neat, right? Now, all of this had me thinking, what happens if the value of the collateral falls? What happens if the price of Ethereum collapses tomorrow? Won't that mean that people would rather hold the DAI than pay it back and convert their ETH? Well, turns out that the Maker team had anticipated it and built in a number of safety mechanisms. The first line of defense against this sort of risk is over-collateralization. The vaults are over-collateralized, which means that more crypto is required to be tied up than you can unlock in DAI. Let's assume that the collateralization ratio is set at 150%. So basically $150 in ETH is required to unlock 100 DAI. So if the value of the collateral, ETH in this case, increases, then the borrower can unlock more DAI up to the collateral threshold. If the value of the collateral falls, then borrowers can choose to either repay borrowed DAI or deposit more collateral as their position approaches the liquidation level. When this liquidation level is hit, the Maker system will trigger an auto liquidation. Now, the mechanics of this can get quite involved, so I'll try my best to explain it as succinctly as possible. Please bear with me. Basically, when the auto liquidation is triggered, then the system carries out a collateral auction. It automatically liquidates the vault and sells off the collateral until the outstanding debt in the vault is covered. There will also be a 13% liquidation penalty that will be covered by the collateral in the vault, with all the remaining collateral returned to the vault owner. This penalty has been implemented in order to disincentivize users from ever being liquidated. If you know that failing to pay down your debt means you lose 13% of your collateral, then you sure as hell are going to want to make sure you avoid that. This liquidation penalty is also put to good use in the system as it's stored in a surplus fund. This surplus is also comprised of the accrued stability fee, and it is used in order to keep the Maker system solvent in times of need. Those times are when the price drops so quickly that no one really wants to take over some of the collateral in the vault. Okay, so what happens if there's not enough surplus funds to cover the shortfall? Then the system will need to initiate a debt auction. In this auction, the winning bidder will pay DAI for MKR to cover outstanding debt that collateral auctions haven't been able to cover. MKR is minted by the system, which increases the supply of Maker's tokens. Still with me so far? Great. Of course, this MKR dilution needs to be counteracted somehow by a decrease of Maker's tokens in the system. This is through the use of a surplus auction. Remember that surplus that I talked about? Well, once it reaches a certain threshold, any additional funds are auctioned off to the community. This is called a surplus auction. In the surplus auction, the winning bidder pays in Maker token to receive a certain amount of DAI. This MKR is then burned, which decreases the supply in the system. Now, I know that this was a bit of a handful, so if you're a bit lost, don't worry. I've linked to some handy resources below that could help. All you really need to know is that Maker have developed an ecosystem that is not only over-collateralized, but one that also penalizes users for failing to post more collateral. So, if you're unable to post collateral to top up the vault, you will automatically lose 13% of the collateral posted. You can think of it as a decentralized smart contract equivalent of a margin liquidation. However, instead of BitMEX getting that liquidation fee, it goes towards keeping the network stable. The auction system is also pretty genius in the way that it counteracts MKR dilution in the debt auction by burning Maker tokens in the surplus auction. What's more interesting than just the mechanics is the fact that it's held out pretty well in practice. The single collateral DAI used in a similar auction system that worked even in the most strenuous market conditions. Here you have the price of ETH from early 2018 to the end of the year. It went from close to $1,500 to a low of below $90. Now take a look at the price of DAI during the same period. Minor oscillations around $1, but seeming to always hold the peg. The mechanism works, and this is all thanks to the dynamics of the auction. There is nobody issuing the tokens, nobody guaranteeing the debt. Nothing other than some smart coding on smart contracts backed by some smart economics. Smart all round. Moving on though, I mentioned the concept of single collateral and multi-collateral DAI, so let's take a bit of a closer look into that, shall we? When the DAI stablecoin was first issued, the collateral required was Ethereum. This meant that you needed to lock up ETH in order to unlock DAI. However, after months of planning, in November of last year, they released their Multicollateral DAI, MCD. The main benefit of this is that you could use more than just ETH in the CDPs, now Vault. You could also use BAT tokens, and they are assessing the possibility of other tokens such as Augur's REP. Multi-collateral DAI brings a number of other important updates and changes to the DAI ecosystem. For one, there is that name change from CDP to Vaults. You also have the multi-collateral variant adopting the DAI ticker, whereas the single collateral type will now be SAI, SAI. Oh, a quick side note here. If you hold single collateral DAI, then you can easily migrate it to the new MCD type. I've linked to some guides below that take you through it. Back to MCD, you also have some changes to the stability fee. With the single collateral DAI, these were paid in Maker tokens. Now, with the launch of MCD, these stability fees can be paid in DAI. You also have something called the DAI savings rate, or DSR. As the name implies, this is a method through which DAI holders can earn returns on their stablecoin. This is done natively within the Maker protocol through the use of another smart contract. Where do these returns come from, you ask? Well, they're basically sourced from the stability fees that are paid by the Maker Vault holders. This is great as it acts as another incentive mechanism to balance out the ecosystem. Since the launch of the DSR, over 67 million DAI have been locked up. At the time of this video, you had a savings rate of 7.5%, which is not that bad. It's about in line with a number of other staking coins, and I'm sure that it's much more than you'll be getting on your fiat savings rate. That's all well and good, but how do you go about earning those returns? This can be done through the use of Maker's Oasis DeFi Hub, so let's now take a look into that. The DeFi Hub brings together three key features of the Maker ecosystem into one simplistic user experience. You have Oasis Trade, Oasis Borrow, and Oasis Save. Oasis Trade is basically a decentralized exchange that allows you to trade your DAI for other ERC20 tokens such as Ethereum and Augur's REP. You can also trade DAI for the USDC stablecoin that we mentioned above. Then you have Oasis Borrow, which is where you can unlock DAI by creating a vault. Through this interface, you can borrow the DAI by locking up Ethereum or BAT. You'll also notice here how over-collateralized the current system is. Essentially, you have more than 3 times the collateral than there is DAI supply. This means that the system is quite secure from any sort of large falls in the value of said collateral. And the final part of the Oasis Hub is the saving mechanism that I mentioned earlier. Here you can lock up your DAI and earn that 7.5% savings rate. Using the Oasis Hub is pretty straightforward. You will need to connect the wallet that has your DAI stored on it. In this case, it was MetaMask for me. Once that's done, you'll need to deploy a proxy, set the allowance, deposit your DAI, and confirm it all. You can then head back to the savings panel and you can see the amount that you've deposited as well as previous transactions. So, pretty straightforward. On the other side of the crypto coin, if you want to borrow DAI, you'll need to lock up collateral in the vault. So, I head on over to Borrow and I click Get Started, which will take me to the vault options I have. Here you can see the exact terms of the vault, which in this case has a 150% liquidity ratio, 13% liquidation fee, and an 8% stability fee. Next step, you choose how much you would like to lock up and how much DAI you would like to generate. Take note though that you need to generate a minimum of 20 DAI in order to set up the vault. You also have to make sure that your collateral ratio is above the minimum of 150%. I would suggest that you deposit much more than this, as 150% is your liquidation level. If ETH markets move lower quickly, you're at risk of being liquidated and losing 13% of the collateral. Once that is done, you can confirm the transaction and the DAI will be sent to your wallet. So, you know how to generate DAI and how to earn interest on it. Let's take a quick look at the market, shall we? DAI is a pretty popular stablecoin and is listed on a number of exchanges. Here you can see the complete list of them. Some of the best names on that list, in my opinion, are Coinbase Pro, Kraken, and Bittrex. You have pretty decent liquidity across all of these exchanges, which means it's pretty easy to execute most order sizes with minimal slippage, even really large block orders. Of course, this is a decentralized stablecoin, so you may also want to stick with that decentralized spirit and use a DEX. You can trade DAI on any number of DEXs, including DAI's own version, limited pairs to trade with though. We've been through a lot, so congratulations for making it this far. I want to leave you with a few final thoughts on DAI. Firstly, I have to say that it's by far my most favourite stablecoin on the market. Cryptocurrency is supposed to be decentralized, and having to rely on a singular entity to maintain a stablecoin is the antithesis of that. Yes, I know that there are other decentralized stablecoins out there, but none of these have the liquidity or track record that DAI has. I'm also pretty psyched about the wide-scale adoption and the use of DAI in the decentralized finance or DeFi space. If you've seen my recent DeFi video, then you'll know why I'm so bullish on the sector. DAI is well positioned at the forefront of this increasingly hot market. Then of course you have that successful launch of the Multicollateral DAI last year. This upgrade went through without a glitch, and the new savings feature gives users the ability to earn a return from their DAI. So it's basically akin to saving dollars in a bank account, except dollars that no one can seize, you can freely move, and that you earn about 7% interest on. Dreamy. Okay, there are still risks. No system is 100% fail-proof, and I cannot say for certain that the Maker system is completely safe from potential exploits. It's also hard to tell exactly how the peg would behave with a cataclysmic fall in collateral value. Edge cases or black swan events happen regularly in financial markets. So I guess all I'm saying is don't sink your life savings into DAI or any other singular asset for that matter. I'm sure your financial advisor would say the same thing. And that, my friends, is my video on the DAI stablecoin. That was quite a long one, but now I need to hear from you. What are your thoughts on DAI? Are you also bullish on DeFi? Any questions for me? Hit me up below. Also, if this video was helpful, then let it be known. Give me a big thumbs up by smashing that like button, and of course, don't forget to subscribe. While I have you, I need to level with you. There's a lot that I could have included in this video that I just did not have the time to cover. That is exactly why I have my weekly newsletter. This is a great way for you to keep up to date with my latest thoughts on the market. I also share some interesting topics and coins that you may not have heard of. Keen? It's really pretty straightforward. Ping over your email in the below sign up form. I'm working on my next newsletter as we speak. Take care, crypto fam.